Hello, guys. It's the next episode of GetBlock Podcast. Here's me, Roman Stich. I'm Chief Commercial at GetBlock. And with me today, Sergey Banov, our DevRel specialist, Alex Alokhin, our head of product, and our guest, Marcus Molleskov, is the Chief Risk and Compliance Officer at Januar and a great expert in European regulation, and maybe not only European regulation. And to be honest, I'm happy to have Marcus today with us, because when we had this opportunity and when we knew that Marcus is ready to join our podcast, I was like, wow, great. Now we have a person we can talk about all this stuff with regulation, with all this MiCA stuff, with all this debanking stuff, and how crypto is working, how banks are working with crypto right now, etc., etc. So, Marcus, I'm happy to have you here. Thank you for joining.
Well, thank you for the invitation. I'm happy to be here.
So, yeah, as I said, we have like a lot of questions, but I would love to start from your introduction about Januar, first of all, and maybe a little bit about your background, because as I said, you have a lot of experience here, but a couple of highlights will be amazing, and it will be our foundation for the next questions. So please go ahead.
Great. So my name is Marcus Molleskov. I'm the Chief Risk and Compliance Officer at Januar. I'm also one of the co-founders. Before founding Januar, I worked with financial risk management for almost 8 years in 2 large Danish banks. Primarily working with what's called counterparty credit risk, which is the intersection between market risk and credit risk. Januar is a Danish payment institution. We are what's called an account-bearing payment institution, which is very unique. It allows us to provide IBANs to our customers, same as an EMI, but we are not allowed to issue stablecoins, and that's basically the only difference between our license and an EMI license. We have our PSD2 license with the Danish FSA. We've passported our license to all 30 EEA countries, so we're active in all of Europe. And on top of the fiat platform of named IBANs, payment infrastructure, those kind of things, we've also built crypto services, which means that we also do MiCA compliant crypto custody, crypto transfer services, and crypto conversions, including on and off ramping. And this allows us to function as a full service financial partner for crypto companies. On top of that, something that is unique is this dual license, which means that we can actually function as an EMT partner for crypto asset service providers, or CASPs, so that they don't need their own PSD2 license in order to provide stablecoin services to their customers. Yeah, but we can maybe dig more into that later, but because that's something that's very topical and very in high demand at the moment.
Yeah, I think so. I think we will touch this question a little bit later. Okay, so when I saw your LinkedIn, when I saw LinkedIn, there was a phrase like bridging banks and crypto, or solving debanking in crypto. So do you understand correctly that debanking is when, for example, crypto business cannot open a bank account right now? So do you understand correctly that that's the meaning, right?
Yes, that is correct. I mean, Januar was originally founded because we were a founding team of 4 people, where one of them owned a website that sold bitcoins to private individuals. And he personally had meetings with every single bank in Denmark that went along the lines of, hello, my name is such and such, I would like to open a corporate account. And then the bank goes, yeah, of course, come on in, have a cup of coffee. What does your company do? Well, I have a website where I sell Bitcoin. And then like, no, we can't help you. Like, okay, just listen to me. I know I've paid plus 50,000 euro to a huge Danish law firm to help me write my AML policies. I'm registered with the Danish FSA. I'm doing everything by the book. If you just look at this documentation package that I brought with me, like, no, we know that crypto is outside of our risk appetite. looking at your documentation would just be a waste of our time. Please leave. Right? Every single bank in Denmark, he's had that meeting.
It was
And
quite
that's when
harsh.
we decided to solve that issue, right? And we also know, being in the industry and being from the crypto industry, we know that it's not just a Danish thing. This is basically a global issue. So we decided to solve that issue by becoming a financial institution ourselves and provide corporate accounts to the crypto companies that need them.
So, and it's happening right now. So it's continued to happen, right? So, but okay, what's the main? I know about this problem, of course. I know about this problem. Everyone in crypto knows about this problem. But actually, I don't clearly understand what's the main issue here. So why do they see crypto business as a risk? So what's the main issue for them?
Yeah, so with me having a banking background, and a risk background, I do understand them, right? So it's a matter of risk and reward. So the problem is that they know nothing about the industry. So for them, whether you make a transaction to Coinbase or whether you make a transaction to a no KYC exchange in China, that is the same for them. It's both crypto, it's equally dangerous, right? And when you're not able to make that differentiation, everything is just critical risk. And you are not allowed to earn enough, because if you're a normal bank, if you're not like targeting the industry, I mean, the amount of crypto clients you would get in a year would be, maybe a handful. And then it's not, you don't get the return on investment for buying a OnChainID software, for training your staff, for building the expertise, those kind of things. That costs a lot of money to build that expertise and to buy those tools, and you don't get the payback in terms of customers, because there's not enough customers that are coming to you, or that are handling crypto. But when you do what we do, when you have the experience in-house, so Simon, our founder and chief strategy officer, he was the first non-engineer Chainalysis, and he was their head of training and customer success. So he basically traveled the world educating all the big exchanges, all the big banks, all the big regulators and FIUs and those kind of things on how to do on-chain analytics. So he more or less wrote the curriculum for digital analysis certifications. So we have all of that knowledge in-house. Then we have a lot of key hires in terms of AML and myself for risk management and compliance and those kind of things. So the combination of this means that we are actually able to go out and do proper risk assessment of these crypto companies. And we believe that we are some of the best in the world at actually making that judgment whether a company is legitimate and competent. So one of the things that we wanted to learn, or have had to learn, is that because we wanted to help the crypto industry. So to a large extent, we believed if we can just filter out the good and the bad, we could train the people who had the right intentions but maybe not had the competence to prevent bad actors from abusing their platform. But we've come to find that is increasingly difficult, also with AI getting smarter and smarter, right? You need a much higher level of sophistication running a crypto business to make sure that you're not being abused by criminals. And at some point we just had to make the decision that, well, if your only experience is having a website that sells t-shirts and you think that you can build a new website selling crypto and do exactly the same things you did when you sold t-shirts, right? That's not gonna work. People need to realize that selling crypto is a financial service, and you need to act like a financial institution. You need to be compliant first. You need to, take care of IT security. You need to take care of operation risks and those kind of things. And it's important that you have those things in place and that you are professional.
Sure. Yeah, I actually have a question for you, Marcus, because you mentioned about the thing that who can be a client and who cannot be. And I'm quite curious, what is this line where you decide who can be your client and who cannot be? What is, who you actually, can aboard to onboard, and it cannot be, probably it's jurisdictional, probably it's about business model. Tell us a little bit about it, please.
Yes, so it is. I mean, we're licensed in Europe, so it's every single legal entity within the European Economic Area, or EEA. That's our core customer group. Then preferably they are somehow related to crypto. So I think 80% of our customers are VASPs and CASPs. We also have a few family offices, few investment funds, a few staking service providers, few crypto merchant service providers, a few independent contractors that are, want to invoice in crypto, those kind of things. We're seeing more and more interest from traditional companies that want to use stablecoins, particularly for cross-border payments. We also see more and more interest from payment service providers, new banks, even one traditional bank that are looking to potentially provide crypto services to their customers. So for PSPs, it would be adding stablecoin payments as part of their payment mix that they offer to their merchants. For new banks and traditional banks, it would be allowing crypto custody or allowing maybe even do crypto trading or something like that. But it's still very early days for the banks. But we are seeing more interest. But coming from a time where, as I talked about, where there's zero risk appetite, and now we're moving in the right direction, but there are a lot of banks who think they're crypto friendly because they don't block transactions to Kraken, right? Then you're a crypto friendly bank. Right? That's not really how it works. If you want to run a company, you need a corporate account. You're still not going to be able to do that with a traditional bank, and that is why we're here.
Sure. And I just probably if you can quickly mention what are the as Zoomers, me personally, say what are the red flags for your company when you see something? Okay, it is EU-based business. It is has its own business model, all this stuff. But what is the probably red flag you see and you understand now we cannot carry on?
Yeah, so we have a proprietary risk scoring and then onboarding questionnaire where we ask people or ask our customers a lot of questions, and then based on their answers, we give them a score, and it comes up high, medium, low. We also do video interviews with all of our customers. There's a surprisingly amount of companies who want an account, and then they find out there's a video interview. We never hear from them again. Right?
Really?
Yeah, really. And sometimes you're right. Sometimes we also do have video calls, and then there'll be some woman who doesn't speak English, and he's like, "What do you know about crypto?" And she knows nothing, right? And then you get suspicious. Those kind of things. But I can't talk in public too much about what exactly it is that we do, but
sure.
But because we are aware that is something that people want. Bank accounts and crypto exchange accounts and those kind of things are traded on the black markets. I think I saw someone who shared a screenshot where the bank that she was working for, accounts to their platform was sold at $4 a piece. Right, so it is cheap. On the contrary, I saw a post on Darknet Market. We did, we continuously screen our own name, and we saw someone post that they were looking for someone to help that person create an account at Januar, and they were willing to discuss pricing. So I think the fact that people are actively looking for someone to help create accounts, and they're willing to discuss pricing, and he's specifically said he's not looking for newbies, he needs someone who's expert in creating these kind of accounts, compared to just accounts being sold in bulk at $4 a piece. I think that's a testament to how diligent and how good we are in Januar to separating the good from the bad, and I'm actually quite proud of that.
Yeah, sure. Thank you. We got it.
And I have, of course, more questions. I would like to specify. So, as you mentioned, as I understand it, and maybe you meant that also, that some banks, of course, are more crypto friendly, and some of them are not. And why is that? Is it just because some banks have this crypto expertise a little bit, and they can like better filter these risks and bad companies, good companies, etc., or there is something else?
Yes and no. I mean, there are a lot of banks who have people within the organization that knows quite a bit about crypto, and some have like experts that know a lot about crypto, but they're usually not at the top of the bank. So they're usually like, you know, some kind of tech specialist or developer, or like a FX trader or something like that trades crypto in his spare time, stuff like that. But you know, I once talked to a portfolio manager who had a quite senior position in a large bank, and he said, you know, he was really interested in crypto and he traded crypto in his spare time, and he really wanted to invest in crypto within his job and allow the customers of the bank to benefit from exposure to crypto markets. But he also knew that it would be a potential career killer if he suggested that to his boss. Right, so the thing is that it comes from the top. So when you have a lot of old white men sitting in the boardroom or sitting at the directors level, who know nothing about crypto except when they see in the newspaper that FTX has collapsed, and they see, you know, Bybit got hacked and those kind of things, and it's just a confirmation bias where they just keep getting reaffirmed that crypto is bad and crypto is only for criminals. They don't realize that when they see, oh, now, you know, 1 billion euro worth of crypto was seized as part of some operation, that is actually a good thing, and actually a testament that crypto crime is less susceptible compared to traditional crime, right? Because in traditional crime, if someone gets scammed and they get their money back, they don't get the actual stolen money back. The bank that they have pays those money out of their own pocket. But in crypto, you can actually trace the funds. So in crypto, when you get your money back, it's actually the money that was stolen from your private criminal, that now the criminal no longer have those money anymore. And that means that criminals in the future will say, okay, maybe crypto is not as beneficial for me to use for money laundering and for fraud, because there is a higher risk that the money will be taken away from me if I'm caught, compared to in the fiat world, where if I steal something and I get caught in a couple of years, those money will never be able to be taken away from me because they will be hidden in, you know, different corporate structures. So even if I get caught, I will still have the money when I get out of jail. Where with crypto, if I get caught, I won't have the money when I get out of jail. But they don't realize that, because they just hear the headlines that, oh, now some crypto assets have been seized by police, and they think, oh, more crime. They don't think the difference between assets being seized and in traditional world where assets are just stolen and no assets are ever really seized.
Interesting. I never thought about that. But yeah, that's kind of.
But I mean, Chainalysis also do, you know, an annual crypto crime report where I think the numbers are like 0.15% or something. Maybe that's like the number from last year. But in traditional finance, we don't know. We don't even know. The only number we have in traditional finance is a number from a conference speech in 2009 where someone said between 2 and 5%.
Lovely.
and that was a number that was taken, I mean, it has no real source other than that speech, right? So in traditional finance, the best estimate is between 2 and 5%, but the truth is we don't know. And in crypto, we're down to like, oh, it's 0.15, and people are like, oh no, but that's not true, you don't take into account a lot of things. Okay, but even if we increase it to 1%, it's still less than the 2 to 5. And the fact that we're discussing, oh, this is a specific number, it might be slightly wrong, maybe we need to adjust it a bit, compared to we don't know, right? That just shows all you need to know about the transparency on crypto, and why clever crypto criminals or clever criminals don't use crypto for money laundering because it's traceable. It's the stupid criminals that use crypto. The clever criminals use the fiat system because there you'll get away with it.
Yeah, it will be a special section for a piece of advice for a stupid and a clever criminal in this GetBlocks podcast. Thank you, Marcus. No, of course, I'm joking. Actually, because we were talking, I have a question, because we were talking about this legal thing, and what do you think is the biggest misconception in general that people have about crypto compliance? And probably what is the gap between perception and what happens in practice? Maybe what some even professionals, people that use crypto on an everyday basis think, what is crypto compliance? But you, because you work with it truly, every day, you do understand now that is right and that is wrong. What is the biggest misconception?
It very much depends who you talk to. I mean, the conferences I usually go to, there's like large institutional crypto actors, like the Coinbases and the Krakens and the more institutionalized side of the crypto world. And then you have like some of the like OG crypto people who's like, oh, there should be no regulation, the code is the regulation, everything is self-regulated. And, sometimes I get to meet those people as well, and sometimes that creates some really good discussions. What I usually say is that whenever people say that MiCA is bad or regulation is bad, I think it very much depends what you want out of crypto. If you want crypto to be a separate system which is used by a few to bypass the traditional financial network, then yes, then maybe it's better that it's not regulated because they can do whatever they want, and it won't really impact the traditional system. But if you think that crypto is a new innovation and has the potential to be the infrastructure of the new financial industry, right? Then you need it to be regulated because institutional investors, they're not going to invest in crypto. They're not going to use blockchains. They're not going to use DeFi platforms to make any kind of investments unless there's market abuse regulation. That means that if someone does a pump and dump scheme, it's illegal and they'll go to jail. At the same time, my mother, she's not gonna start using stablecoins or crypto to pay for anything unless there's consumer protection laws that's gonna protect her against scams. It's gonna potentially reimburse her if she has a loss, right? Those kind of things. If we want wide adoption, we need these kind of regulations, and that's sometimes what people, have a misconception about, that we don't need regulation. It really much depends what you do. If you want, wide adoption into the global ecosystem of anything, of merchants, of finance, of anything really, then we do need those adoptions, and that is why I generally think MiCA is a good thing. I think there's a few unfortunate things with MiCA, but in general I actually think MiCA is a good regulation, and some of the implementations and interpretations made by the regulators implementing it have been unfortunate.
You said that you mostly like MiCA,
Yes.
but what you don't like about MiCA?
Yes. And that's actually a really specific thing. I'm glad you asked. What I don't like about MiCA, and the thing I hope the most they'll be able to change with MiCA 2, is the fact that there's no way for a small company to operate under MiCA, right? So today we have thousands, I think it's between 4,000 and 5,000 VASPs. So a virtual asset service provider, which are people who are registered under the old regulation and are currently under grandfathering. And a lot of those companies are 1-2 person companies that has a website that sells crypto, kind of like the t-shirt shop, right? And there's no way for them to upgrade to get a MiCA license and become a financial institution unless they go all in and they get a VC and they hire people, because it's almost impossible to comply with MiCA if you're less than 10 people, right? Because you need dedicated director, you need a dedicated MLO, you need a dedicated compliance officer. You probably need 2 compliance officers actually, and so that's 4 people in overhead, and then you need actual operations team, you need tech team, you need sales people, you need those kind of things. So it's really, really difficult to actually comply with MiCA and meet the compliance burden or compliance overhead of getting a MiCA license if you're less than 10 people. And that means that the proportionality statements that are made in DORA kicks in. I don't know if you're aware, but DORA is this digital cyber resilience act that is same as NIS2, but for financial institutions. And DORA says, because there's a lot of small 1-2 person investment firms and those kind of things that have a MiFID license, and the regulators were like, oh, we can't push the full burden of DORA onto these small companies. So we're gonna say if you're less than 10 people in your company, you only need to do this small section of DORA. But if you're more than 10 people, you need to do the full DORA. And when you have a MiCA and you can't really get a MiCA license with less than 10 people, that means you also need to do the full DORA. And that means, 1 additional compliance employee at least, and, third-party risk managers and those kind of things. And when we started out as a payment institution, our journey was that we initially applied for what's called a limited payment institution license. And there's also such a thing as a limited e-money institution license, so limited EMI. And the difference between a full license and a limited license is that for the limited license, you're not allowed to process more than 3 million euro a month in transactions, and it cannot be passported to other countries from the country that you got the license in. But it's much easier to get, it's faster to get, there's not the same regulatory requirements, the application package is not as big, so it becomes much faster, much easier to get that limited license and to comply with the requirements of the limited license. Unfortunately, there's no such thing as a limited CASP license under MiCA. And that is the big thing that I really miss. Because if we had a limited CASP, you could set up a 1-person, 2-person website, get a limited CASP license and run that within your own country. And once you grew and you became large enough to hit 3 million euro a month in transaction volumes, then you could upgrade for a full license. And unfortunately, what we are seeing now, I mean, we have a lot of customers, and quite a large amount of them are moving out of Europe. We have a fraction that is closing down, just saying, okay, we're not going to get a MiCA license. I'm going to close down my company. I'm going to go do something else. Then we have another section which is being sold off, where they say, okay, I actually have quite a decent list of customers. I have a well-known brand in my jurisdiction, something like that. I'm going to sell that brand to another crypto company that's going to be able to get a CASP license. And then we have a few that are moving to Switzerland or Canada or some island state or something like that. And that's kind of the 3 groups. And then of course you have the groups of the larger that are able to actually get the MiCA license. But the problem is that this underforest, all these small companies, they will never be allowed in, and they will never be able to grow and become a new large crypto company, right? And that's a big problem, because that really hits the innovation in the European crypto ecosystem.
Got it. Actually, I have a question, because still we are talking about the legal side of the question. Personally, I totally agree with you when we were talking that if we want this mass adoption thing to happen, we need regulation. And me personally, as a person with law degree, I totally agree with you. Yeah, and my question is following. We see that Europe has MiCA, but we also do understand that the crypto is not just only about Europe. And we can see that, for example, the US has regulation almost for every state. Dubai has, for example, I think it is called VARA regulation. Hong Kong has its own regulation. Do you think that those regulation systems, at the end of the day, they are converging on, we are heading towards a quite, not really united crypto legal landscape? What is your opinion on this matter?
I mean, I hope we will get there someday. I don't think so. I mean, Europe is generally on the forefront of this. I mean, MiCA, I've talked with a few regulators, both from the US and from the UK and Asia, and they say that they're all looking to MiCA as an inspiration for how to write their regulation. So in a sense, by being first, there is a chance that MiCA will somehow be the gold standard that everyone will measure up against, and hopefully that will make it easier for European companies that are MiCA compliant to move abroad, because a lot of the regulation will look like the regulation that they're used to. Unfortunately, there's also the ability for people to go in and tweak and those kind of things. I know the UK, they've looked at MiCA and they said, okay, that's a good gold standard, but we want crypto companies to actually come to UK. So it's almost like at every single thing is okay, this is good, but how can we make it more easy going on the crypto companies? And then they've just tweaked it all the way down to make it easier to be a crypto company in the UK, right? Because they want to they want to entice all the crypto companies to come to UK. And then there's other restrictions where they tighten one place and loosen another place, and everybody tries to do their own thing, and in the end you will end up with something that is not comparable, even though it's all based on the same foundation. Because crypto truly is a global ecosystem and a global product, it's the same Bitcoin everywhere in the world, it would make sense that this might be the first industry where we actually have global regulation. But I don't think that we have any organizations we don't have FN or WTO or something like that could actually go in and set a global standard. I mean, for AML we have FATF that acts as a global money laundering organization that kind of sets down the guidelines for how to do anti-financial crime prevention regulation, those kind of things. But even though we have FATF, the AML regulation in different countries is still vastly different. So even if we did have some kind of organization that was, okay, now we want global rules for crypto, how are we going to do it? I don't necessarily think that it will work in practice.
Got it.
But
Actually,
it's a nice idea.
Yeah, actually, when you mentioned UK and the golden standard, I remembered about the recent interview of the CEO and founder of Revolut, Nikolai Staronsky, when he told to the interviewer that they are trying to get US bank license. It's probably, that's quite a hard thing to get, yeah, quite difficult. And he told that sometimes US regulators can directly tell to a company that we will not even observe your application before you get some license in countries like UK, France, and Germany. Because they do understand it's about, golden standard. When you already got license in the UK and France, the US regulators think, okay, now it's more trustable right now. And probably the same thing may happen with MiCA in this sense.
Yeah, I think so. And hopefully, we have other things, right? We have already in financial regulation where we say we have equivalent laws. So if you're an EMI in Europe, you can you're not passport, but then you can get a UK EMI license as a subsidiary. You don't need to create a separate legal entity in the UK in order to get your UK EMI license. Of course, that's because it's the same regulation. It was written before Brexit, But
Yeah.
but still, there's also other. I know there's a lot of. At some point, I looked in Jersey to see if we could onboard a Jersey company. So I looked at the Jerseyan regulation. They're like, oh, if you have a license in the UK, then you can do it because we call that an equivalent license to our license, sort of thing, right? So there are these. So the concept of an equivalent license exists, and maybe that's something that regulators might want to look more into, where say, okay, do we want Europe? If we think Europe is a good standard, and we generally are reducing the requirements on ours, then maybe we should let all European licensed entities act on our markets without doing a lot of other additional work and getting an additional license and those kind of things. So that is something but I think that is something that could be done, and hopefully by Europe being first and a lot of the regulation using MiCA as a template, it could potentially be easier for European companies to get that status in other jurisdictions. But I think it requires a lot of, but that's more like a lot of what's called diplomatic work, right? So then the EU regulators have to go to the foreign, so someone in EU Parliament have to go to Dubai regulators and say, hey, we see that your regulation is similar to ours. Would you please allow our crypto companies to act on your markets based on their European license?
Yeah, sure.
Because that's not something that you can just do. But again, a global framework, so everybody has the same crypto rules, that would be really, really nice. It would make my life a lot easier once we start looking into new jurisdictions, new licenses, and all those things. But the way regulation is written today and the way it acts across, there's so many incentives and so much political play in terms of, oh no, we want to do this because then they can't, and those kind of things. So I think I don't think it's ever going to happen, but wish it would be.
Yeah.
I'd like to continue with this MiCA topic. And actually, I have, maybe it's a tricky question, maybe not, but actually, as I understand, MiCA regulates mostly centralized companies, centralized project. Am I right? So it's mostly taxes and payment solutions in crypto on ramp, etc., etc. So, but actually the next big step is regulation, as I understand it, the regulation of decentralized solutions, decentralized technologies. And actually, it looks like a tricky question and like a tricky task. But I'd like to hear your opinion regarding how should a decentralized market should be regulated, and what's the best approach here?
Yeah. Actually, I can highly recommend reading a opinion piece written by the Danish FSA on how to regulate decentralized entities, or specifically decentralized exchanges. Something that I also often say when people ask where to apply for their license, it depends very much on what you're doing as a crypto company. Because, for instance, the Danish regulator, they've spent a lot of time researching DeFi, because the MakerDAO Foundation has some Danish founders in it. So they have had a close relationship with the MakerDAO and trying to find out and consulted the MakerDAO Foundation on how to be regulated and whether they were decentralized enough, those kind of things. So there are some people in the Danish FSA who spend a lot of time wrapping their hands around how to regulate decentralized entities. And on the contrary, we don't really have a large exchange in Denmark, so they don't really know a lot about CASPs. But then you have the Austrian regulator, who've had a close collaboration with Bitpanda for many years, right? So they know a lot about how to supervise and regulate a CASP. So, so it's depending on which what your company do, you will benefit from going to different jurisdictions. So specifically for the decentralized regulation of decentralized entities, what I thought was a brilliant opinion from the Danish regulator was that they will not regulate the infrastructure, they will regulate the interface. And that means that if we take Uniswap as an example, they will not regulate whatever Uniswap has built on a smart contract level, because that is open source, everybody can connect with it. But the website, uniswap.com, that is providing financial infrastructure, and that should be regulated according to the Danish FSA. And I do think that is correct, because if you are providing exchange services, it doesn't really matter whether your infrastructure is hosted on AWS or whether it's hosted on a blockchain. You are still providing exchange services. So, and in that sense, you should be regulated. The clever thing now is that because it is built on blockchain and everyone can interact with it, it's really important that they don't regulate the infrastructure. Because I could set up my own, I could set up marcusswap.com and hook up to all the Uniswap infrastructure. And the important thing then is that Uniswap is in no way liable for whatever happens on my website. Even though they created the smart contracts and created all of the exchange infrastructure, they are not liable. They are only liable for what happens on their website. And that means that if I'm a criminal and I connect directly to Uniswap and I start making changes and swaps and whatever, I'm a criminal, I do what I do, but Uniswap is not liable for its customers matching orders with my orders. Because it happens underneath, they have not led me as a criminal onto the platform. So that is the huge distinction on how to regulate decentralized infrastructure. And in some sense, I think it makes sense. Today we have a lot of decentralized marketplaces, but they don't really share liquidity. I mean, right now, one of the biggest competitive advantages of the different decentralized exchanges is liquidity and depth of the order book and sizes of pools and those kind of things. In my opinion, that shouldn't be the case. You should have one global, in the same way that we have, one Ethereum blockchain, right, or one Bitcoin blockchain, right? You have one blockchain where ideally all things would be on, because then they're more interchangeable. It's easier to connect and interact with each other. As soon as we have 100 blockchains, I mean, the last blockchain is not going to be worth as much. They might if you build your own blockchain to build a dApp, why not build that dApp on one of the major blockchains that are already in existence, right? And it's sort of the same with the decentralized exchanges. I could go out now, I could build my own smart contracts and stuff to build a decentralized exchange, but it really provides very little value compared to if I just build an interface to the Uniswap smart contracts. And then I could compete with Uniswap on customer service, consumer protection, preventing financial crime, those kind of things, where I personally think that the competition should be, because then we have the same underlying infrastructure, we have the same underlying liquidity and those kind of things. And that also improves the overall liquidity for every market if everyone was pointing to the same underlying smart contract, right? The question then is who earns, right? Is it the platform that allows people to interact with smart contracts? Could you create a business on that? Or is it only the people who develop the smart contracts who are earning the fees, right? And that's the question. But
I agree with this point, and more than that, we see the same trend right now. I mean, for example, we are RPC node provider, right? We provide the access to the blockchain nodes, and we see the whole statistics because we are like top 10 on the market. We have a huge traffic, we have a huge user base, and we see the dynamic. And of course, there is just 3-5 top blockchains which have the biggest part of market, right? And all these like hundreds of chains, they're not popular at all, and it's like works the same. Market already solved this problem
Yeah.
somehow. So yeah, we see that. Okay. I want. Yeah, Alex, go ahead. Sure.
Marcus, do you think that On-Chain ID will be mandatory from some point in the future? Because there are already frameworks for that, and as I remember properly, Tokenization did great standard. Actually, it's a full-fledged framework for building crypto assets that fully regulated. All transfers are regulated. A lot of checks. It's modular. And my question is, how regulators see on-chain ID, and how you see future of this stack?
Yeah, I mean, it's already there, right? So we already have the IDIS 2.0 regulation, which is the regulation that governs electronic IDs in Europe. I know that there's a Danish startup called Deas, who happens to have built a crypto, or not crypto, but a blockchain wallet for IDs and a lot of stuff. And and they're already live in Denmark, which means that every Dane actually already have a crypto wallet that holds their IDs. So it's just something that will happen. It's already here. It's just a matter of getting it out to people. And then in general, I think we don't necessarily need to tell people that it's blockchain. I think one of the huge issues with wide adoption of crypto and of blockchain is that we are all kind of fanboying on the technology and the infrastructure. So we keep telling people, oh, this is a crypto blockchain solution, where most people don't care. They want to send a message, or they want to get money somewhere fast, or whatever it is. They just want their problem to be solved. They don't care which infrastructure it runs on. And I think that's generally something that we do wrong in crypto and the blockchain space, is that we try and sell the technology instead of selling the solution. Because if you have digital IDs and they work, who cares if they're running on blockchain or something else? But I do think that it will come, and it will likely be a blockchain solution. And as I said, it's going to be even more so. So we're going to get more and more of this, and it's going to be more widely accepted. And at some point, it's going to be necessary as well, because AI is here, and I also do a lot on fraud and AML and those kind of things. Are in those forums, and I can see that passports today. I mean, a lot of banks are still using passports as the primary identification of their customers, and it's not worth anything anymore. I mean, it's so easy for criminals to forge a passport. And not only forge it, but to create a completely new passport from nothing is also possible, right? So you can create an entirely new person that never existed, which means that the passport will never be reported stolen either. So it's those kind of things where suddenly requiring a passport and a birth certificate and a utility bill from someone and say, okay, now I know you're a real person, I can onboard you. I mean, a person with access to an AI that doesn't have any guardrails, they can create those 3 documents in 10 minutes. So it's not really worth anything. The only thing that really works, and that we will need even more so in the future, is on-chain IDs or digital IDs that cannot be faked and that cannot be generated out of nothing. Because if you have such an ID, then you can sign for yourself, and then you can prove that you are a real person and that you are who you say you are.
Got it.
And then we just need to get people to, take better care of them so they're not stolen.
So you think that industry will handle it under the hood? It will be hidden from a customer?
Yeah.
Everything will,
Yes.
even if on-chain ID will be presented in this architecture and system, it will be hidden from customer. And it's a company that deal with compliance, AML, KYC, will manage all the things on-chain. Customer will know about it, and they will...
I don't know if they will handle everything on-chain, because for some reason I still think that the banks will continue to, require passports and all those things. And, to be honest, I mean, actually it's just a huge, liability to have all of that documentation on your customers, because if you get hacked as a bank or as a financial institution or as anyone who does any kind of KYC, right, then it's just all of your customers' personal data that is leaked or stolen or whatever. The ideal thing would be that someone comes in, you say, please sign with your government issued digital ID. They sign. I don't get any of the data. I just know that I can now prove that something was signed and that I know who that was. I don't even need to know the name, right? And then if something happens down the line and I want to report that person to the police, I send the hash to the police and say, here's the hash of the signing. They can then go in and collect the data of that person. I mean, it's only the only reason that we need to know who makes the transaction. That is to make sure that in case we need to report something to police, we know who to report. If we can make that report using a hash from a signed transaction that has been signed by a government ID, I don't actually need to know who did it. I just need to know which hash to send to the police and say, this person did something bad, please go look at it. Of course, there's some other things, like, for instance, I earlier talked about all the stuff that we do in Januar to verify that our customers are legitimate, those kind of things, right? And for that, we need to know more about the customers. So we can go look up their website, we can go look up their addresses, we can go do a lot of checks to make sure that they're actually who they say they are. But I think we could get very, very far, and there's a lot of those checks that we could probably eliminate and save a lot of resources if we were able to just, get that signing and be done with it. And hopefully, the entire society will move in that direction. Because we're wasting so much money on KYC as a society.
Yes, that's true. That's true.
And it's not really working, and we don't really. It's just a huge cost thing. It's not really working. It's just making a lot of people, potentially liable for having their data stolen and those kind of things.
Yeah, that's true. That's true. I have small questions, but I want to come back to the first part of our conversation. So you said that despite all of this lack of expertise in banking, etc., there is still a growing interest among banks to join this crypto market and create some products there or anything else. So what's the mark of this interest? How do you see that? And which opportunities do the banks see in this market for them?
Yeah. I mean, there's a ton of opportunities, right? First, to be clear, there's a ton of opportunities. I think I heard somewhere that JP Morgan processes about $10 trillion worth of payments a day. And if that can be taken over by stablecoins in one way or another, right, then that's a huge, well, first of all, it's a huge loss for JP Morgan, but it's potentially a huge win for all of the banks that are paying JP Morgan fees in order to process those international transactions. Because the reason is, right now we have JP Morgan at the top, then we have Citi next to them, almost a bit below, but then every single bank has an account with them. And then under all of those banks, which are called, so these are layer 1, and then layer or tier 2 banks, they then have banks underneath, which are tier 3 banks, and then sometimes there's even tier 4 banks, right? Which means that if a tier 4 bank down here, wants to send money to another tier 4 bank, across the world, then it has to go through all the way to the top to JP Morgan, and then down all the way through a lot of banks. And you can sometimes have, 5-7 banks in between a payment from one jurisdiction to another, especially if you go from third world country to third world country, right? So if you go from an African country to a Southeast Asian country, then you can easily have 7 banks in between, and they all need to take a fee. But if you go to stablecoins, then those banks can do that transaction directly between each other, or even the merchants can do it directly or the companies can do it directly between each other if it's fully on-chain. So there's a lot of these things where we get more peer-to-peer payments on a global scale if we move to stablecoins. On top of that, we have tokenization of assets, which again is a huge thing. I mean, we have so many financial assets that are traded every day. Again, I have an economics background, and in economics we often talk about GDP, or like the wealth of the world, as money times velocity. So for instance, if I go to a fair and I bring a 100 euro note, that's the money part, and then I buy something from Roman for 100 euro. He then buys something from Sergey for 100 euro, and Sergey buys something from Alex for 100 euro. Now with 100 euro note, we've made 4 transactions. That equals 400 euro worth of GDP. Okay. Now imagine if Roman had to wait 2 days before the 100 euro landed on his account, and then only then could he go to Sergey, and then Sergey had to wait 2 days, and then he could go to Alex, right? And that is actually what's happening in the financial markets today. So today we have $2 trillion worth of shares traded on the US stock market. We have $5 trillion worth of bonds traded on the US bond market daily. And we have, I think it's about $9 trillion worth of derivatives traded on the US derivatives market. So again, only in US. They are the largest market, but only in US. And they all have between 2 and 5 days settlement, which means that you have to wait 2 days before you can go and spend those money on something else. If we can compress that down to an hour by tokenizing financial assets, the the velocity factor of that equation goes through the roof, which means that global wealth will go through the roof. On top of that, all banks are holding capital to cover the settlement risk and those kind of things for that period. So again, when that goes down, the settlement risk goes down, banks need to hold less capital, which means that they can lend more, which means more economic activity. It becomes sort of a flywheel effect. So by tokenizing financial assets, we can potentially start a new golden era of the world by releasing a lot of wealth into society. Not because the wealth is magically created or something, but by simply reducing financial frictions that allows the economic system to function more effectively, and that in itself creates more wealth. And I just think that that's really important. One thing that's worth mentioning though is that this tokenization of financial assets, we're not quite ready yet, because if I want to buy a tokenized stock, it doesn't make sense if I have to do a SWIFT transfer to pay for it. Right, we need the on-chain payment method or on-chain value that we can pay with in exchange for the stock. That is when the value is created, and that is when value is unlocked. And the best value to do that by right now is stablecoins. But as I mentioned, we have 2 trillion stocks, 5 trillion bonds, and 9 trillion derivatives traded daily. But we only had 300 billion issued stablecoins, right? So even though the stablecoin market had grown by 80% in 2025, we don't have nearly enough issued stablecoins to actually facilitate those financial markets yet. But I do believe that with institutional adoption, we are starting to see more corporates look into stablecoin uses for global payments, those kind of things. And that means that we will have more issuance of stablecoins every single day. And I do believe that, again, we had about 80% growth in stablecoin issuance in 2025, and I think we will have at least that in 2026 as well. So if we have that, like almost a doubling every year, it won't be that many years before we have enough issued stablecoins to actually start facilitating financial markets. And that is when tokenization of financial assets starts to become really, really interesting. Once we tokenize financial assets, we can then start looking at tokenizing real world assets. There is a lot of people right now who talk about tokenization of real world assets, But just because you are able to tokenize a building and sell it in fractions, that doesn't automatically create liquidity. Liquidity comes from markets being able and having market makers and those kind of things, and it's just too complex an asset. It's kind of the same with bonds and stocks, right? So even when I talk about tokenizing bonds, we're not actually gonna see the same benefit of tokenizing bonds as we see from tokenizing stocks, because Google has one share. Google actually has two, right? They have an A and a B share. And that is complex for people to find out, okay, what's the difference between the two shares? Why do I trade one? Why don't they have the same price? All those things, right? But Google probably has 20 bond issuances that have, different maturity, different time to settle, time to expire, different maturity, different seniority, different yield, different coupon, those kind of things, right? And that's going to be even more complex for people to comprehend. And you might even have two bonds that have exactly the same time to expiry, exactly the same seniority, and exactly the same yield or coupon. But there could be something in the covenants of the bond, which is like a 1,000-page document that says, oh, in case of this, this, and that, then this bond don't have to be repaid, but where the other still has. And that is why they have a different price. But unless you read that 1,000-page document, you're not gonna know. So bond market, and that is why bond market to this day still is primarily for institutional investors. And you have to pay like 100,000 euro or something like that to buy a bond. That's like the minimum ticket size. But by bringing the ticket size of a bond down to 100 euro, that's not going to create a lot of liquidity, because there's not a lot of private people that want to invest in bonds, that have the time and the skill to actually go in and read those bond documents and assess whether a bond is priced right compared to another, even for the same company. So when everybody's talking about, oh, we need to tokenize, intellectual property and have it trading in a marketplace and those kind of things, I'm like, yeah, that's fine, maybe in a few years. But there's other things that is more in front of us that has a higher benefit of being tokenized.
So the company that building platform for tokenization is one of the main profiles of your current customers, right?
Yeah.
Got it.
Well, it's I would like to have much more. It's not like we have maybe a handful of tokenization platforms. The majority of our customers are crypto brokers and crypto exchanges.
That's good. Actually, it's a quite good perspective. Instead of building your own company trying to solve this debanking issue.
Yeah.
But yeah, that's good. Gentlemen, we are running out of time.
Yes.
I suppose already.
Yeah.
So
maybe one last thing, the EMT thing. I said earlier we would get back to it, but we haven't gotten back to it yet.
That's true. But yeah, maybe we can do the second episode. I don't know,
we can do a second episode on EMTs and stablecoins in general. I can talk about that for half an hour or an hour.
Okay.
Sounds good.
Why not? Yes, sounds good. But actually, for today, I think
Yes.
we can finish here. Marcus, thank you very much for your expertise, for your thoughts, for your answers. It was like a great journey. I learned a lot actually today, and I appreciate that. Thank you very much. So, and to our audience, guys, if you want to learn more about Januar, I really recommend you to see their website, to subscribe to Marcus' profile on LinkedIn. He shares a lot of interesting things in his social media. So, and stay with GetBlock for more interesting insights and podcast. See you guys. Thank you.
Yeah, thank you, Marcus.
Thank you, Marcus.